Financial crises don't start with screaming traders or red headlines. They start quietly, in spreadsheets, in side agreements, in small corners of the system nobody watches. By the time you feel panic, the damage is already done. Here's how it spreads. First, credit gets cheap. Banks lend aggressively, funds borrow even more aggressively. Leverage stacks on leverage. On paper, everything looks stable because asset prices are rising. Rising prices make balance sheets look stronger. Stronger balance sheets justify more borrowing. It feels safe. Then something small breaks. Maybe a few borrowers miss payments. Maybe a niche market, commercial real estate, subprime loans, sovereign bonds starts wobbling. Losses seem contained, isolated. That word shows up a lot. But modern finance is built on connections. Banks lend to funds. Funds use banks for leverage. Institutions insure each other. Everyone owns pieces of everyone else's risk, quietly. When one balance sheet weakens, lenders pull back, not out of panic, out of policy. Risk models tighten, credit lines shrink, assets get sold to raise cash, prices fall. Falling prices weaken more balance sheets. Now the math turns against everyone at once. Only then does panic appear. The irony, the crisis spreads long before fear does. It moves through contracts, collateral calls, and liquidity shortages, mechanical, emotionless. By the time headlines say contagion, the system has already been rewired. So the real question isn't when people panic, it's where leverage is quietly piling up right now.